Good morning. Welcome back to the Main Management Weekly Market Note podcast. Today I'm flying solo. My name is James Maxwell, SVP of Research here. Let's go ahead and get started. Just as a starting point, want to remind all our listeners of our 4 ETFs. If you have anything of interest, feel free to reach out. On the week and year-to-date performance so far, there's been a kind of move towards, I would say, the risk on cyclical sectors and areas of the market. So you can see on the left-hand side there for the broad indexes, small cap leads the way considerably, up almost 4.6% for the week ended, over 5% year to date. That's way ahead of almost everything else, almost double the return across the board there. You see something similar on the sector-wide landscape year to date, looking like materials, industrials, energy, these very kind of cyclical, risk on, kind of economically sensitive areas of the market are doing better than the rest. If you look at something like even tech, that's a 1.5 year to date. Obviously, that's been leading the way for a number of years. So it's interesting to see that kind of dynamic there, where the risk on areas that maybe have been lagging a little bit more are now leading the way, the more pro-cyclical, old economy areas of the market, like materials and industrials rather than tech. I know there's been some commentary that part of this might be caused by some tax selling starting the year. These sectors, maybe there's selling of tech now that it's a new year, and that was the leader to take advantage of the tax. But regardless, we'll kind of keep an eye on this, see if that trend continues. Going to the recession dashboard, no major changes right now. A lot of the data out this past week was on employment, so we'll be talking about the outlook for that, as well as we'll get inflation data this week. So that's something to keep an eye on. Starting out with the headline non-farm payrolls report, overall it came in a bit lower than expected at plus 50,000 jobs in December. That was against the forecast of plus 60,000. The unemployment rate declined slightly. Labor force shrunk by minus 46,000. The participation rate also ticked down. Across the board, it was kind of a choose your own adventure type of report is what I've heard it referred to as. What I mean by that is there's kind of places in the report for both bulls and bears that you can find things to support your narrative. On a high level, I would say it continues to suggest the labor market is moderating overall. It's not falling apart. It's not hugely negative, but there's not a large number of signs suggesting further strength. If anything, it's kind of further weakness around the edges. One positive, and we mentioned this here, is that wages accelerated, which is strong for consumer spending, given that real wages, so wages adjusted for inflation, continue to be positive. Looking closer at those wages as well as the participation rate, you can see that black line or dark blue line ticked down. That's the overall labor force participation rate. So looking at the entire labor force and how many people are participating. That green line is what we call the prime working age cohort. So it's 25 to 54 years old, kind of the most productive demographic within the labor market. And that's actually reaching almost at an all-time high there. You can see relative to history, it's very, very elevated, which is strong for kind of longer-term economic outlook. On wages, and I just mentioned this, you can see that dark blue line has been running above that green line, which is the CPI inflation number, for just over 2 years now, meaning that basically people are getting paid more and more, increasing their wages at a faster rate than inflation is increasing, which is a strong sign for consumer spending, people able to spend more of their money on discretionary items, overall a positive for the economy. Looking at the industries and kind of within that unemployment level in this report, I'll say on the industries, one thing to keep an eye on is there's been education and health services has led the way for a number of months now on the kind of industry that lost employees. A lot of it's these like cyclical construction, non-farm goods producers, trade, transportation, these very cyclical, economically sensitive industries, which is something that isn't great to see. Typically, you want those cyclical industries to be leading the way. And you can actually see, we mentioned here, cyclical industries. So if you exclude government, um, exclude education and healthcare, we were actually down minus 4,000 in December. We can also see on the right here on the unemployment, one of the things that you can look at is how long people have been unemployed. And that's sort of a measure to look at, um, how the duration of how long people are unemployed. It's a measure of, how strong the labor market is, how people are easily able to find jobs. And overall, what we're seeing is that orange line, which is people being unemployed for the long term, so more than 27 weeks, has been rising for a number of years. That's not a great sign for the kind of underlying dynamics of the labor market, because it implies it's harder and harder for people to find jobs, especially if they've been out of work for 1, 2, 3, 4, 5 months. It becomes increasingly hard for them to re-enter the labor force, re-enter and find a job for themselves. One good thing that we got last week was on Q3 productivity. Productivity we like to refer to as kind of the lifeblood of the economy. It's a hard to measure part of the economy. It's not really a raw thing that you can measure. It's a residual for measuring kind of total output, and then what was put into into it in terms of labor hours. That is that the residual from that is basically productivity, how much you're able to get out of each hour of labor. Um, what the good sign was is it jumped 4.9% above forecast for 3% raise. And overall, we're keeping an eye on this for a few reasons. One of the things that we've been flagging is AI adoption is becoming increasingly widespread. AI, you know, regardless of what you think about it, helps increase productivity, and should continue to help increase productivity in the longer term as it gets better and better. That's also a good thing for the Fed. It puts less pressure on inflation. It allows for basically more output again without putting in higher, without resulting in higher inflation. So that's overall a good thing for the Fed's outlook. Again, these are longer term things. Productivity runs on 5 or 10-year cycles. So quarter to quarter, it's more of like a gut check. It's just a checkup on how it's going. If you actually look on the longer term, it gets distorted a little bit. On the right-hand side here, we're looking at the 20-quarter or 5-year rolling productivity growth. We're actually picking up a period right now where it rolls over the COVID jump that you saw. Again, COVID had a lot of data distortions. You can still see those showing up today, especially when you're looking at longer-term trends. So now the 20-quarter average has actually dropped because one of the good quarters during COVID fell off. But what we'll say is that we expect that to kind of rebound over the next few quarters. I think that's more of a data distortion than anything. But if you're looking at actually the quarter-to-quarter current trends, those are pretty positive. Also on the left here, I'll mention we have unit labor costs, which is a measure of kind of wage pressures in the economy. Another kind of inflation measure or an input to inflation is how much does labor cost quarter over quarter. And that's actually been coming down here for the second quarter in a row. Another sign that inflation is not hugely problematic. We'll be actually getting CPI this week, so we can get a closer look at that. But overall, our view is that inflation is not going to be a huge problem going forward. On JOLTS, so this report's a month kind of delayed, so to speak. It comes out regarding November, even though we're already in January here. But basically, what it allows you to do is look closer at the labor market and where hires and openings and quits and layoffs are all coming from. This report overall, openings came in a little worse than expected. 7.15 million, well below forecast for 7.6 million figure. Hires remain kind of just depressed or low. That just continues to be this kind of low fires, low hires environment. One thing to take away, though, is that quits, that light blue line on the right side, actually ticked back up to 3.16 million, which is the biggest monthly increase since May of 2023. One reason to look at the quits number is it's typically an indication of kind of labor market sentiment among workers. If people are confident they're able to find another job, they're way more likely to quit their current job versus if it's a recession, there's no jobs available, they're not going to just go out and quit, just, hoping that they're going to find another job. So it is a kind of indicator that people are more confident in their ability to find work. That is one data point. There's plenty of other data points that also say, confidence is low. And again, this is from November, so we're a month and a half to late here, but it is good to see at least something pointing in that direction. But overall, it continues to point, I said, say broadly towards moderation. Like I mentioned earlier, there's a kind of this continued moderation in the labor market. We also got the ADP payrolls, which is private payrolls, kind of another measure of employment outside of the government released statistics. It actually had a 41,000 job rise from November's minus 29,000 decline. So that was a positive. You can also look within that ADP. They have small, medium, and large firms. And small and medium actually did pretty well during the month, especially relative to the past few months and even past year. We also got the job cut announcements from Challenger Grain Christmas. This is something that looks at announcements of job cuts from corporations. It's those headlines when you say, Nestle's cutting 10,000 jobs or whatever the headline might be. 2025 was actually the first full year since they've started recording the data where cuts outpaced hires. So that's another indication that, broadly the labor market has weakened, has softened. On a look forward basis, it's kind of not falling apart, but there's certainly not as much strength as there was a couple of years ago. We also got the trade balance numbers this week, and this was actually a very surprising report in some ways, and also not surprising in others. The balance narrowed to minus 29 billion in October, 29.4 billion in October, and that's actually the lowest level since June of 2009. A lot of that was driven by, as you'd expect, higher exports and lower imports. I will say that, when the Trump administration came in January and started speaking about the issues with the trade balance, wanting to bring that back down, obviously you had the tariff announcements, not only at the beginning of the year, but continually getting those. I think there's this goal of reducing the trade balance or the trade deficit, and you can see in the data that goal is being reached, or at least in the right direction for what they're looking at. When you import or when you enforce tariffs on imports, obviously you're going to get fewer imports and more exports. I think that's from a very basic economic standpoint, it's working. Whether or not that's the right thing for the economy, whether or not that's a good thing, is debated. I would say, from a GDP standpoint, it's better to have companies producing locally and then exporting. But that is, obviously a hotly debated topic. Within that, imports, obviously goods is the bulk of imports and exports, 71% of the total. You can really see that discretion or that discrepancy between the imports and exports on the left-hand side there, that kind of red line continuing to come down with imports, and then the gold line below being exports spiking up here over the past few months. This might be some, changing of supply chains in the short term. It's hard to say how much of this is going to be permanent or, continually moving on a go forward basis. But it is, again, it's what the Trump administration probably wants to see. Moving to the housing market, the housing market in our words remains stuck. A large part of that obviously boils down to mortgage rates. There's a lot of commentary about institutional ownership of single family homes, of manipulation, of wanting to bring the mortgage rates down, all these kind of goals of the Trump administration and others. But I'll say, like, it's hard to blame those things. I think the real root of it is just mortgage rates and rates more broadly are higher than they were 10 years ago when people started to put on their mortgages. It's hard to convince someone to go from a 3% to a 6% mortgage. There's little you can really do to incentivize them to do that. Anything you would have to do would probably be, require Congress approval, whether that was some sort of tax credit, something else. Rates are high, and certainly it's hard to see those going lower in the short term. Obviously, one of the headlines this weekend was the pressure that Powell is facing from the Trump administration on lowering rates. That's kind of an actively developing story. But one thing I will say is that less Fed independence is probably not a good thing for interest rates. I mean, you've seen it in plenty of other countries when there is kind of a political interest in their central bank. Typically, that's not a good thing for rates. Rates are typically going higher in that case, but we'll see. We'll see how that kind of goes. Whether it's pressure on the short end of the curve or pressure on the long end, but we'll see from here. And that's all for this week. Obviously, a lot of labor market data. Kind of as I mentioned, broadly a moderation in the labor market. There's signs that it's somewhat stabilizing. There's signs that it's not being, going to be as bad as feared. But ultimately, I think the labor market is what's driving the conversation. A lot of the kind of Fed forecasts on a number of cuts, again, is really, really driven by the labor market. It's kind of, how many cuts how many cuts are going to happen this year? Well, what's the unemployment rate going to be at the end of the year? That's really the question. And it seems like there's risks to the upside. It's not falling apart again, but certainly there are risks. On the positive side, productivity continues to be strong. It's actually the best reading since Q3 of 2023. And also you have less inflation pressure. So certainly on the short-term interest rates, inflation dropping is a good thing. You also saw JOLTS reinforce that message. ADPs kind of reinforce that message of labor market's not falling apart. It's not super strong. And then finally, trade deficit narrowed. Again, probably a goal of the Trump administration. And finally, in the housing market, there's just a lot of stagnation there, primarily driven by just higher mortgage rates than kind of the post 2009 trend has been. For a long time, mortgage rates you could get at 3 or 4%. Now they're at 6+%. It's just hard to make it valuable for people to move or build new houses or whatever it might be. Affordability is obviously an issue there. This week, we will be getting the CPI, PPI, import and export prices. We'll also be getting some industrial production and manufacturing output at the end of the week. But overall, that is it for this week. Hope you all are doing well, and we'll see you next time.